Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated. Welcome back to the Working Wealth Podcast. I'm Patrick Rogers.
And I'm Trevor Rasmussen.
And we are bringing you part 2 of the basics of insurance.
Everyone's favorite subject, like we already talked about, Patrick.
That's right.
This time, we get to talk about the insurance that we actually don't recommend.
Yeah, which is really, really fun. It might get a little bit controversial here for a second or two, but we think it's important. The last episode we talked about, some very basics, like a big flyover of the insurance you definitely should have and some understanding of the different components of those insurances, some basic recommendations there. But I think it's very important to take time and talk about all the different types of products that are out there. And realistically, we can't cover every single product, right? But just break down some of the more common ones that people do come across and maybe why we shouldn't worry about them.
Yep.
Like why we shouldn't have to spend money on things that ultimately might not be worth it.
Yeah, absolutely. This will get spicy. We're going to definitely preface it with that, just because, we all know that person in our life who sells, different types of insurance. And we're not talking about life insurance on this episode, but there could be some people that think, no, you know what? I really do need that coverage in my life. And that's okay. But we're going to kind of break each of them down and really just talk about the pros and cons to all of them.
Yeah, exactly. So let's dive in here. Let's start at the top of the list. So credit life and credit disability insurance. Let's break down for the people. What is credit life and credit disability insurance?
Yep. So essentially what this insurance does is it pays loans that you have outstanding in the event of your death. And this one is really good. It pulls at our heartstrings. We say, oh, well, I don't want to pass, debt on through my estate to the people that I love in my life and have them be negatively affected. So I need a policy in place to cover that debt if I'm gone, so that they get the stuff unimpeded.
And why would we not want that? Because practically, if I have a loan and I have debt and I don't have the resources to pay for it, which is probably the reason why I have the loan to start with.
Yep.
Why would I not want to have protection? If it's an extra, $5 or $6 or $7 a month, Trevor, it sounds like a great idea.
It does. And you will definitely talk to salesmen who will tell you the exact same thing. But really, if you're in a position where you don't have a lot of assets and don't have a lot of money to actually get yourself out of the debt while you're alive, chances are you're probably not going to be passing a whole lot anyway on. So really, we're paying for coverage that really we don't need. Also, consumer debt is not passed on directly to our descendants or people that we give our assets to after death.
Yeah, it all goes to your estate, and then that gets reconciled during the probate process, handled that way. Yeah, and I think the key thing here is if we're going to have some kind of life insurance product or in some cases a disability type product to cover us if we have an outstanding loan, we probably have a bigger, deeper issue here, right?
Yes.
If it's for a $17,000 loan, maybe we should work on the fundamentals and figure out how to pay off that debt or not go into debt for things like that in the future, which granted, there's always things in life, life happens, medical debt or other things. But if this is a small life insurance policy to cover a car loan or a lawnmower loan or something like that, and we should really consider the reason why we got in the situation to start with.
Yep, absolutely. And also at the end of the day, it's usually not going to be an amount that really moves the needle too much in anyone's scenario. So
right, exactly. Yeah, and also just practically speaking, these types of coverage, these types of policies, it's kind of like payday loans.
Yep.
It's exponentially more expensive than anything else because they're selling you a product with that emotional tie or with the feeling side of it to say, oh, well, you need to buy this to give yourself or give your family this kind of protection. And they're just adding it on as an additional cost.
Yep.
In my mind, it's kind of like if I buy something online and the next screen after I click submit, it pops up, but wait, here's a 10-minute window. You can buy this additional product that most other people also buy for 25% off. Do you want to add it with one click? It's that same kind of concept, right? Well, no, I wasn't planning to spend another $75, but since you give me a 10-minute window, like maybe, maybe I should spend this extra $75, right? So yeah, it's a gimmick, right? At the end of the day.
It is. And I just feel like, once again, it goes back to, let's think about it critically. If I'm paying money monthly to have this coverage on this loan, why don't I just use my money instead of buying a insurance policy to cover that debt, to use it to actually pay down the debt?
Yeah.
Like you said.
Right.
So,
2
and 2 makes 4. Let's follow that arithmetic.
It smells like a duck and it sounds like a duck, and So, all that said, avoid that stuff at all costs, right? Another kind of insurance, which kind of falls in the same category, is mortgage protection insurance. And this is not to be confused with like PMI, private mortgage insurance, which is also, actually, we don't have this on the list. We should definitely try to avoid that.
Yeah,
right?
absolutely.
That's a ripoff and a gimmick anyway, because it's not insurance for you; it's insurance against you for the lender, right? But this is mortgage protection insurance. So break down mortgage protection insurance for us.
Yep. So this is a very similar concept to the credit life or credit disability insurance. Really, the policy is written to cover your mortgage in the event of your death. So you buy a house when you're in your 30s and you've got $200,000 outstanding on it. You buy a policy that essentially covers that $200,000 balance left on the mortgage. In the event of your death, the insurance policy pays out and your mortgage is free and clear. Once again, this pulls at our heartstrings because we go, oh, well, I gotta leave a debt-free home to my spouse or my kids or whatever it is. And the salesmen that sell these products know that. They're very good at playing to those fears and those feelings, which are well intended, but it's one of those things. It's going to be super, super expensive to actually put it in place, and we can just get normal term life insurance in place to cover our mortgage after we die.
Yeah, exactly. And this is one of those things where we would always default to, hey, let's just actually look at our total financial picture and evaluate what our actual needs are instead of just falling for every dollar on the duck trick, right? And a couple of things that I should have said this at the top is most insurance is sold, not bought.
Very true.
And think about that for a second. Most insurance products are sold, not bought. I don't wake up in the middle of the night saying, oh my gosh, I need to have cancer policy in place. No, it's like somebody approaches me and says, well, hey, have you thought about this? Here's all the reasons we should have it. Here's the value proposition, blah, 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 blah. And then the emotional heartstrings or whatever else gets pulled. And then that's when I end up buying stuff. So you have to be very cautious of what is someone's motivation when they are approaching you about stuff. Second thing is with these kinds of policies, they are guaranteed issue. They're not traditionally underwritten. So they're not actually doing a due diligence on who you are, what your lifestyle is, what your health classification is, all that kind of stuff. It's literally they scrub court records and public records to where they can find out who just got a mortgage. They have your address, they have the property information, they know what the loan closing amount was, and then they generate a form letter, send it to your home right after you close, says, hey, Mr. and Mrs. So-and-so, you have this loan, you need to buy this policy, and here's the price. It's going to be more expensive. It's not enough coverage in general. And also, it's just kind of slimy.
Absolutely.
You're using court records to try to sell me products. It's really disgusting overall. So now I will say though, every product does have a place, and there's certain cases where if you can't get products other ways, this might be a solution, specifically the mortgage one. If you are uninsurable for other reasons and you buy a home, getting a policy that doesn't require an underwriting process could be beneficial, but let's still default 99.9% of the time to being proactive and intentional to get sufficiently what we need.
Yeah, absolutely. And that's a great point. You always run into those one-off cases where someone can't qualify for term life insurance. Medically, physically, they don't qualify. They're deemed uninsurable by the insurance company. And so if you're not going through that underwriting process and you've got some other avenues to get some coverage, it may or may not be a good play for you.
Yeah, exactly. All right, next on the list.
Yeah, this one's a fun one.
Okay.
AD&D.
AD&D.
All right. So accidental death and and dismemberment. Yes. Thank you. It's a beautiful, beautiful name for this, this insurance.
It makes me feel really warm and fuzzy inside, right? So AD&D, accidental death and dismemberment, right? It's literally in the name what it covers.
Yep.
If I die or if I lose a member, get dismembered, lose an arm, lose a finger, I lose a digit, right? In an accident.
It has to be in an accident.
That's how it gets paid out.
Yes.
If your employer provides it, which a lot of big companies do, that's great. They'll give you like 1 or 2 times your salary, that kind of stuff.
Yeah.
But if you're getting offered to pay another, $5, $10, $15, $25 per paycheck to buy this stuff, it's like a life insurance policy, but it's more restrictive because you have to die in an accident.
Yep. The chances of dying are already fairly low in, based on your health and your, your age and your profession and all those kind of things. But let's just say that you already have a very low chance of dying. You have a higher chance of becoming disabled than you do dying. Now we're going to make it even more unlikely that this policy pays out by making your death accidental versus having just a heart attack or natural causes be your demise. So,
and I think a lot of people, they can look at that and they say, well, hey, like any death before I'm like 75, 85, 95 years old must be an accident. But in terms of the way the policies are written is there's specific criteria to define or determine, well, what qualifies as an accident.
Yep.
Sometimes car accidents are excluded, right? Like I'm not saying that for all of them, but I've seen that where they have their own lawyers writing these things to allow them to make money and not necessarily pay out claims for every possible claim case that comes in. So in general, employer pays for it, great. But if you're having to pay extra money for this stuff, really not worth it. Let's put that towards the right kind of life insurance that'll pay out in all cases.
Also, please, please, please do not confuse AD&D coverage as life insurance.
Right.
Not the same thing. We've heard heartbreaking stories about people who think that they have life insurance in place. Their husband or their wife unfortunately passes away from natural causes, heart attack or a stroke or something like that. That's not written into an AD&D policy, and they think that they're going to get a big payout from the policy that they thought they had, and really the death doesn't qualify. So now they are emotionally, just disrupted in their entire life because they've had a loved one pass away tragically and unexpectedly. And now they have to deal with the financial burden of losing that person's income and also no support or coverage coming from a policy. So please, please, please don't confuse AD&D with traditional life insurance.
Yeah. Great word. I appreciate that. All right. We talked in our last episode about disability coverage.
Yep.
And we talked about long-term disability. We didn't really define at the time, I realized what long-term disability is very well. It's like long-term disability is coverage to provide replacement of income for lost income because you can't work now because you are disabled.
Yep.
Now, long-term disability, typically you have or any disability insurance, you typically have like an exclusion period, right? A period of time where you have to be unable to work and generate income or earn income before the claim can be paid out. For long-term, it's typically going to be a coverage that stays in force for a long period of time, right? Your exclusion period is typically 6 months. For a lot of policies, like you have to be disabled for 6 months, sometimes 90 days. But then you can have that payout up until like age 65 or for a number of years, right? So this one, and we like long-term disability, right? For the reasons you mentioned, is you're statistically more likely to become disabled than you are to pass away prematurely. So this one is short-term disability. So short-term disability, similar structure, but it's designed to pay out for a shorter period of time, meaning up to 90 days or up to 6 months, that kind of thing. You still have an exclusion period. Usually it's 2 weeks or a month, like 1 or 2 pay cycles, depending on your job. But again, this is one of those where it's kind of like, well, this makes sense, right? Like if I'm out of work, like shouldn't I have some kind of income coming in?
It bridges the gap, right? Between my short-term and my long-term disability needs. So it makes sense. And this is exactly how the people who sell these products will market it to you. They'll say, oh, well, you need to bridge the gap for that intermediate period in between when you actually get your long-term disability coverage in place. We tell people, Patrick, every single day that come into our our office doors. You should be living through the Ramsey principles. Baby step 3 is build up an emergency fund of 3 to 6 months of expenses.
Mm-hmm.
That's going to bridge that gap perfectly for you. That 3 to 6 month gap while you're waiting for your long-term disability coverage to kick in. If you've got that in your bank account, you effectively have short-term disability. You don't need to be paying for it on top of that.
Right. It's just self-funded insurance, right? Which is, again, we went back to the definition of insurance in our last episode of it's a transfer of risk, right? So we're just choosing to assume that risk versus transfer that risk. Mm-hmm. Because again, the cost in most cases is going to be not prohibitive, but it's going to be more expensive to buy a small amount of coverage for like a week's pay or every 2 weeks pay than it is to just have $25,000, $30,000 in savings.
Mm-hmm. And once again, a lot of employers offer short-term disability as part of their, their benefits packages. If your employer pays for it or gives it to you for a really, really reduced rate, might not be a bad call for you. Mm-hmm. If you're going into the marketplace and buying it on your own, most of the time it does not make sense.
Yeah, exactly. All right, this one is a big one.
Yeah.
And we're seeing cases like this all the time, every day. Cancer insurance.
Yeah.
Cancer's on the rise.
Yep.
Right? So again, this is we can justify this 100 ways to Sunday, right? Yep. And I would even include in here is not just cancer insurance, but cancer and critical illness policies. Mm-hmm. Yeah. We see these a lot with state employees, school teachers, police officers, things like that, where they have all these benefits programs that are lumped onto their core benefits. Mm-hmm. The challenge with these is, cancer is a covered condition under normal health insurance, as are critical illnesses. Critical illnesses are typically defined as, could be chronic diabetes, it could be heart disease, could be anything of the nature like that. Those are already covered under health insurance. Yep. Now, the trade-off is these policies do sometimes give you like a lump sum payment, right? Or like a hospital insurance, where it's, hey, you get $1,000 for an ambulance ride, something like that. But if you look at the numbers, right, if you're paying $12 a month for this coverage and you get $1,000 check to cover a hospital ride, well, I mean, if you do this for 10 years, you could have just had the money saved up for the hospital ride. Yep. Yes, there's always scenarios where life happens and you have a series of unfortunate events and things of that nature, right? Mm-hmm. I get that. But what I've seen in practice is a lot of clients that have paid for these types of coverage over time forget they have that coverage when the actual claim situation comes up. They never claim on it. They keep paying the premiums and they don't actually get the benefit, even though they had a justifiable claim. So that these, and you add to that what you want to add, but they don't seem like a worthwhile investment when you already have that coverage in place and you could focus on other things.
Absolutely. And I don't really have anything to add, other than I'm going to keep going back to when someone is selling you this type of policy, always be thinking in the back of your mind, what do they have to gain from this? How likely is it that I'm ever actually going to have to use this policy? And that isn't always, the concrete answer of whether you should or shouldn't get insurance, because, I don't usually think about how, things are going to go poorly in my life. That doesn't mean I shouldn't still protect against them, right? Mm-hmm. But with some of these more niche, specific insurance policies, you just really need to think critically about, okay, if I'm already getting this service and these illnesses covered in my normal health insurance, do I really need additional coverage on top of that and pay an additional amount to this provider who's trying to sell it to me?
Right.
So.
Yeah. Awesome. So next one on the list.
Yep. Prepaid burial service.
Yeah.
So there is a clear distinction here between prepaying and pre-planning. Pre-planning, we would both say that's a great thing. You should pre-plan your wishes after death. You should pre-plan all the things that you do or don't want to plan for that scenario. Prepaying, though, that's a little bit different. You want to go into that, Patrick?
Yeah. So prepaying, a lot of times it's again, it all goes back to that emotional sale, right? Yep. If you're doing the prepaid burial service and you're talking through all the options, and you're basically kind of like buying an options contract. Yep. Is I'm presuming that the cost is going to go up exponentially from now until then. And I don't want my family to have to take money out of savings or investments to pay for these services. So I'm just going to go ahead and prepay for it. Mm-hmm. The reality is like costs don't go up that much on that. They haven't gone up that much over the past 15, 20, 25, 30 years. Also, like when you are making those decisions now, like the purchasing of it, you will oftentimes get sold on additional features. Like if I want the very fancy mahogany casket that cost $17,500,
triple stained with
and lined with different kinds of padding and felt and like whatever else, right? Like I don't need that stuff. Mm-hmm. Like I might be convinced that I need that right now, but at the end of the day, like throw me in the oven, I'm done, right? Yeah. It's just you can plan it all out. You don't need to get suckered into that emotional sale of the flower packages and all this other kind of stuff. Because also there's a side of this where how do you know they're actually going to do all that stuff?
You don't.
Like maybe you prepay for it and then you move 15 years down the road out of state and you got to move to be closer to your kids because your kids are going to be taking care of you. Are you going to travel back to that original state to have your burial service where you prepaid for everything?
Absolutely not.
No, not at all, right? So it's like there's so many components of this that just really don't make sense.
There are more things that have to go right almost for everything to be enacted the way that you wanted and paid for ahead of time than wrong. And the odds of that happening are just slim to none, I would say.
Exactly. Yeah. And to distinguish this, right? So we talked a little bit about kind of a pseudo insurance or pseudo defense mechanism in our last episode. Go ahead and get the estate plan updated. Mm-hmm. That's a key thing. This is separate, right? Yeah. Now I'd say the planning of the burial service or planning of end of life stuff, that's part of estate planning overall. Like if you're at that stage of life, but going ahead and like prepaying for all the services, really not worth it at this point in time. And also, if we're doing everything else right in our financial life, there will be plenty of cash. There will be plenty of investments to pay for this, possibly a life insurance benefit. You don't need to have all that stuff paid for today.
The estate will cover the $10,000 to $20,000 to $30,000 of expenses all in to put me in the ground.
Yeah, and also let's say I prepay at $10,000 today and I don't die for 15 years, and I put that $10,000 instead of that, I put that into just a good growth stock mutual fund for the next 15 years. Well, that $10,000 is now $40,000 under historical market returns, right? That's just using the rule of 72, doubles every 12 years or doubles every 6 years in that case, 12% rate of return. Like it's going to grow. There's going to be more money. You don't have to worry about that at that point in time.
Absolutely agreed.
Okay. Return of premium or waiver of premium insurance.
So essentially what this is you're buying insurance on your insurance premiums. So you're buying insurance for your insurance. Essentially the idea of this is, you're paying monthly premiums or yearly premiums for an insurance policy. And let's just say that you get to the end of the policy and you never actually used the benefit. Mm-hmm. If you buy this kind of insurance, your premiums will get returned to you. Mm-hmm. And so it's just one of those things. It just doesn't make a lot of sense. You're buying insurance on your insurance.
Yeah. And a lot of times the cost of that is anywhere from, it could be as low as a few dollars a month if you're really, really young, you're really, really healthy, like on life insurance or disability insurance. But sometimes it's upwards of $15, $20, $25 a month for that additional add-on. And if you just think about, hey, I'm just going to buy the pure insurance and I'm going to take the difference of that and use that to actually fund my future, fund my life goals, invest for the future, you will come out much better ahead. And also just understand at its core, insurance in general is not an investment. Insurance by design is to be that defense mechanism to allow us to invest and grow and live with the rest of our money. So get the sufficient coverage, get the right coverage for a good, fair price, and then move on. It's a sunk cost. You pay for it. You don't want to have to use it. Just don't worry about having to get that money back.
And I think, Patrick, that's spot on. None of us like paying insurance premiums. I mean, I don't, you don't. Nobody wants to pay an insurance company to have coverage in place, especially when we don't use it. However, that is just kind of, unfortunately, the cost of doing business. You're transferring risk and you're paying for that service. And that is something that we should pay for and not pay to transfer the risk of that on that risk we're already transferring. It just doesn't make any sense.
Yeah. Also, if I ended up paying like $3,000 in premiums over 20 years and I get that money back 20 years down the road, I mean, who cares?
Yeah, exactly.
Right?
Exactly.
Like if I've done everything else right and I have enough resources saved and invested, I'm not worried about that money coming back to me.
Yeah.
At that point in time.
Absolutely.
So next on the list.
All right. This one is probably going to throw some people off a little bit because we always think of these things as really, really solid, but dental and vision. Dental and vision insurance. If your workplace provides it, great. That is incredible. Typically, when you run the analysis on going to get your eyes checked or going, semi-annually or, 3 times a year to the dentist, most of the time these policies actually, you're going to spend more in the coverage than you do the actual services just out of pocket.
Yeah.
That's not always the case. You can always check with your provider, but most of the time, if you run the analysis on how much money in premium am I going to pay for the year and how much benefit am I going to get versus what the cost would have just been, it's usually very close or in favor of just paying out of pocket.
Yeah. And again, it's a catastrophic thing, right? Like if you have a lot of dental issues, or you have a lot of corrective issues or health issues with your eyes, yeah, sure. Like let's go ahead and get those things. And it is subsidized to the employer, but being self-employed, I have a group vision policy because I wear contacts and glasses. The reality is it costs me like $8 a month, right? And the actual benefit I get is $130 towards contacts once a year. Saving me like $60, it's not a whole lot of money, right? Now, if I have a situation of, contacts and needing glasses, that kind of stuff, I can kind of double up on benefits. But how often is that? It's rare. And on the eye side, like your eye health is covered under health insurance.
Absolutely.
So you really don't need to just tack on all these things because you think you need those things. Let's be very strategic about, hey, what is our actual situation and make those purchases.
And a lot of these providers, a lot of eye doctors, a lot of dentists around your area, if you go and talk to them and say, hey, I don't have insurance, is there any type of deal you can cut me or can you work with me on the pricing? Oftentimes they will. They'll say, oh yeah, great. Absolutely. We actually offer a 50% off, for your procedures if you pay us $50. They will work with you oftentimes. And in a lot of, scenarios, that's actually going to save you money in the long run than it would be to go into the marketplace and buy traditional insurance for dental and vision.
Exactly. Yeah. All right. And then I added one to the list because it kind of ties in with all the other ones and the way we started this conversation. Not really the focus of this episode. We'll talk more about this type of insurance here on the next episode. But baby life insurance.
These are typically, once again, pulling at the heartstrings, Patrick.
It's pulling at the heartstrings. And I mean, we've gotten these advertisements with both of our kids being born. It's Gerber is the primary one, right? And other companies that they're sending these letters, these mailers, like, oh, you should buy this policy to protect, to have the death benefit in place, to provide if something were to, God forbid, happen to your child. Oh, and it's also a special type of policy where it's going to have a savings account where once they reach age 18 or age 21, they can cash it out. They can use it for whatever they need at that point in time. It's a bona fide whole life insurance policy is what it is. And it's more of an emotional play. The reality is the death benefits are usually anywhere from $10,000 to $25,000. We don't wish ill will for anyone to have to deal with losing a child. I've seen it many, many times, and it is one of the absolute worst situations you can deal with. And that's not to say that if you had some cash in that moment, like that wouldn't help. Like obviously, practically speaking, that could be a benefit for burial expenses and things of that nature. But don't buy something just off of an emotional sale from a company that you think is reputable, trying to help you out. Like, and there's several companies out there that do this. So, but I think that the key thing is every product does have a purpose and has a place. Just don't fall in. Don't fall into being suckered into things is the key thing.
And when we think about, the cost of the policy invested on your own or saved for your child even from a young age, you run the math on it. it never makes sense, very rarely makes sense to buy a policy like this when you could take the same amount of money monthly or yearly and save it on the side or invest it on the side for your child's behalf as they're growing up. You're going to come out ahead. You're going to have more money available in most cases to actually take care of, those kind of things if you really need to.
Yeah, exactly. And a lot of those, like if it's $10 a month, right? $10 a month is $120 a year. $120 a year for 18 years is a little bit under $2,000, right?
Yep.
Roughly. So 1,200, 2,400 minus 240. Yeah. So 2,160-ish, right?
Yep.
So you got $2,200 roughly.
Yep.
If you had invested that $2,200 in the same amount of time into a 529 or a custodial account, or even if you use one of these new Trump accounts that they're talking about these days, you could have a lot more money saved up for that child to use at that point in time.
Absolutely. Yep.
So
really main theme with all these, the people selling these products are going to be trying to get you emotionally involved or convince you that you need to be afraid about something. Or convince you that this niche product is not something that you already have covered in other areas of your insurance life.
That's a good distinction. Yeah.
So really, those three things are the telltale signs of these products being pushed, and so be on the lookout for those. Sometimes, in very, very rare circumstances, like we said, they may make sense, but in virtually all of the scenarios, they just really don't pan out.
Yeah. And again, with that, like products have a place, but be very, very cautious and very intentional with that purchase.
Yep.
Yeah.
Absolutely.
Awesome. Well, if you guys have any other ideas, if you've come across other topics or other products out there we didn't cover that you feel like is kind of the same thing, let us know. We'd love that feedback, and we can maybe do a highlight or a spotlight on that stuff.
Yeah.
But thanks for joining us today, and have a good one. Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated.